Welcome back to the Goofy Investing channel where we talk about investing into the stock market. This is going to be a video about Honest. I did post a video on Honest about a month ago and got a little bit of traction and some interest. So I think Crude Boxing, he wanted to, he asked some question about post earnings on their recent earnings, and I pretty much told him I'll do another video for that. Hey, man of my word, here we are. Here's the video. So let's get into it. Let's go to price action first. Let's see what this stock has been doing. Year to date, we're 28.79% in the green. 1 year return from today is 191.10%. Pretty impressive return. However, overshadowed since inception of their IPO, they're down 77.73%. That's typical. These companies go IPO and stock tanks because this is the little secret that a lot of people don't know about. They think a lot of investment bankers are actually there to make investments. Some of them are in a different divisions, sure, but and that's on the buy side of the market and so forth. But a majority of the job of an investment banker is to collect fees on the IPO, on a traditional IPO, and to try to sell the equity for as much as possible to the investor. All right. An investor's job, an individual investor's job, well, not really a job, but a job per se, is to get the equity at the cheapest amount possible. All right. So that's something to think about, looking at it from different angles. But back to Honest Company, they're trading at $4.25 a share right now. I've reviewed their quarterly earnings. I've listened to the conference call. I've been researching macroeconomical trends as well. I won't talk too much about it, but yeah, so excellent quarter. I have to admit, I'm pretty impressed, and there's a couple things that impresses me. Yes, they're reaccelerating their revenue growth, which we'll talk about, and they're expanding their margins. And the new leadership is pretty much, they understand what wealth creation is. But one of the things that I caught on to this earnings call that really impressed me is, despite the consumer, a weakened consumer, which is trading down in a lot of these commodity products, this brand remains to be strong, and the numbers back it up. A lot of the consumers that are buying these products, I'll admit, here's another thing that's kind of a moat. Okay. So if we'll take Honest Company, they sell diapers, right? And we'll take your generic Walmart diaper brand. Okay. I think it's called Parents' Choice or whatever. Now, yes, they're both diapers. However, they're different types of diapers. So if you have these parents that are more conscious about the materials of the diapers and so forth, and far as ESG, skin irritation for their child, there's not really much to trade down to. Okay, so I think that's one, that there's a little moat there that has been created, which has backed the brand strength of it. Sure, they got some competitors, and the competitors may be seeing some growth too, but people tend to navigate more towards lifestyle brands that sell a variety of SKUs, if you will, as averse to just singular what companies that are just one trick ponies with one product. So, people appreciate having a more lifestyle brand too, to keep things more simplistic in their lives. So let's look at some of the highlights for the quarter. Okay. Um, very very impressive stuff here. We'll hit this little spot here. They got this is their revenue breakdown on a diversified model for their lifestyle brands. Yeah, their makeup, diapers, wipes. They have bath products and so forth. One of the main hit products that's really getting popular on Amazon and in Walmart right now is their lavender bubble bath product. That's getting a lot of traction with the consumer. A lot of people are starting to buy that. But this, yes, right now, 63% of their portfolio is diapers and wipes. Like I said before in my prior video, get it how you can get it. But as from years to come, as an investor, if I was invested in this company, I would be looking to see more diversification in their revenue model for years to come, with a lot of patience. Okay. That's something that I would be paying attention to. And I'll probably be covering this on my channel for a while. So I'll be continuing to do more videos on Honest. Um, so their brand in the Target consumer store in America, the Honest brand is now the number one diaper in Target versus the competitors that are as far as sales and so forth. Okay, so that's pretty impressive. All right. Um, so they talk about the next chapter of Honest. They did their IPO in 2021. They put the new management started entering in 2023. They had their transformation initiative, which is still happening today, but they started this back in 2023 to 2024. And this transformation initiative has really, really been, how do you say, garnering extreme results in the right direction. Karl is doing it. I mean, I gotta say it. I had doubts, but she's doing it. She's delivering. All right. And I guess never underestimate a CEO that knows what they're doing and has a vision and starts executing. Um, so their transformation journey, brand maximization, enhancement, and operating discipline. You see this with the expanding margins, and they're going to increase more marketing spend as the year goes along. And mind you, into a weaker economy, into a weaker consumer, which is pretty impressive. Um, 600 basis points year over year on their gross margin, and they're doing 11 million in adjusted EBITDA. So, I mean, pretty good stuff. Their balance sheet has improved there. We'll talk about that in a bit. But here is their gross margin versus their operating expense. If from Q3 to Q4, their operating expenses lowered nearly 9%, went from 41% to 32%, and their gross margin expanded 32% to 34%. Their actual On their actual earnings, let's see here. Yep, they had their double beat. So let me see here. They posted 10%. They posted 10% revenue growth. All right. And they beat by 5.96 million. Um, EPS beat as well. They beat by a cent. Let's go to their earnings estimates real quick. Analysts got them not being profitable until 2026. I will say this: if they continue to capitalize on margin expansion, revenue growth keeps accelerating, um, they're going to be profitable next year if they keep up with this rate. So that's maybe by the end of next year, but if they keep on this trajectory, this stock will fly next year. All right. Going back to their quarterly report, positive adjusted EBITDA went from negative to 4.3 million in positive adjusted EBITDA. This is important. A lot of banks will be assessing the credit ratings of honest company. Here's the idea: earnings before interest, taxes, and depreciation. EBITDA is assessed there. All right. Banks will look at the credit quality based on the potential of being able to issue out bonds, loaning money to the company, and the company's ability to handle leverage for that actual debt market. That's pretty much what the corporate credit rating is the ideology of it, and why EBITDA is one of the an important metrics to a company. All right. But continuing on, all right. Um, Let me see. They gave results from 2023. Let's go to, oh, they have 0 million, $0, and that's, I'm tracking an outstanding debt. So they're not going to, what that means is they're not going to be having to pay interest just yet. We'll go to their actual financial statement. We'll go to their cash flow. All right, we'll go down, check out their cash flows. They are positive on a quarterly basis. We are seeing positive cash flow. All right, you see the difference between unleveraged free cash flow and leverage free cash flow. Um, they're the same, and that's because they're not paying interest on any debts. Okay, so seeing slight increase into these free cash flows quarter over quarter, but decline from a year over year comparison from 13 million to 5 million. And that's fine as long as the operating, as long as they're getting closer to operating in free cash flows or cash from operations on a regular sustainable basis. That's what matters. Okay, free cash flows will come in the business model if they keep expanding margins and have a good balance sheet and incur money from treasuries. Okay. All right, let's look at their guidance. So their last quarter, they were guiding low to mid single percent digital growth. And then they were guiding for adjusted EBITDA. They were guiding low to mid single digit millions. Now they're in the double digit millions for their guide on their positive adjusted EBITDA. And they've also raised their revenue projection for the end of the year to mid to high single digit percentage growth. Very impressive. Now they're raising guidance. They're getting more better free cash flows. They're getting more traction with their brand. The global, and they're doing research to back up their strategy. All right, a lot of their strategy is based on long-term economic trends of research of the consumer. They also have their in-house brand that tests the products for different allergens and so forth. So that may be a better an additional moat as well. All right, to keep the fidelity of their product and brand. Global sensitive skincare products market size. It's projected right now. It's 41 billion. By 2030, it's expected to be about double to 80 billion. So plenty of growth in the macro trend. They will, once they start getting traction and more people start getting honest brand exposure and start figuring out more about this company, they will continue to, their revenues will exceed and outpace that growth rate as they take market share. All right. Um, so I mean, very impressive quarter out of Honest. I have nothing bad to say. Now, what do I think is going to happen with the stock? Well, if they keep executing like this, the stock's going to continue to go up. If they're raising guidance to, if they're raising guidance into a weaker macro and increasing their marketing spend, all right, they're confident that the consumer wants this. Their subscription model is on Amazon, and their actual direct to consumer website has seen increased traction. Okay, that SaaS model has not been projected in their quarterly earnings, so analysts are not going to be able to garner projections on their pricing models and award a higher valuation later. So what does that mean? That means eventually when they start getting to more scale on their subscription model, they can start, and if they start incorporating that into their quarterly earnings report and reporting this to Wall Street, Wall Street will take this SaaS model and award a higher, and very, very probable, Wall Street will award a higher valuation multiple on Honest for their price targeting based on that SaaS model. All right. Because the safer, more projected dollar made through profit, all right, means the more expensive of a multiple that should command, especially in this category. All right. Um, we'll take a look again. Earnings estimates. I think that right now, I think next year, all these numbers right here are probably too low. If they increase their marketing spend, increase SKU space into these actual storefronts, we can be seeing double digit growth if they're guiding by the end of this year into a weak consumer to high single digit rates. That marketing spend for the second half of this year will start kicking in next year, and very possible to once again to see double digit projections. Um, yeah, so that's my video on Honest. I hope you got some value. I think that investors in this company should take a very long term trajectory approach. This is more of a I'm going to hold this for 15 years because it's going to be the next Procter and Gamble, and they're going to take market share from Procter and Gamble, and definitely see a lot of, a multi bag over the course of over a decade. That's what this is that type of idea. One thing that I'm looking at to consider on their actual valuation basis, on their price to sales metric, and the closer to profitability they are, and the more market share they're taking, and what they're trading at right now, this could be an acquisition target for one of the bigger players, such as Procter and Gamble. So that's something to look at. Kimberly and Clark might be another one of those players that maybe they're seeing stagnated growth, and maybe they want to do a merger and acquisition, and they might look at Honest as the answer to their problem. Okay, so um, if I was an investor, and that should be the disclosure, I don't hold shares in the company. So here you are, you're getting a non-bias, well, yeah, non-bias assessment of what they're doing. So that's something to consider. That merger and acquisition thing. If I was an investor, I would not want them to get acquired. I would want them to continue to grow and gain market share and allow them to create value for my shares. All right. So if you're getting value, be sure to like and subscribe. Check out my Patreon, link in the description. Thumbs up. I'll continue to be covering Honest for probably years to come. And if they keep executing and I start seeing different angles and stuff, who knows? Maybe I might even be a shareholder. But that's what I got for today. Until the next time, enjoy your weekend.